Welcome to Financial Perspectives, the podcast, where we cover timely topics related to the current economic environment and keep you up to date on investment news. We also provide insights on how investors can maintain a long-term perspective. Please stick around at the end for important disclosure information. More information about Foster Group can be found in our ADV brochure at fostergrp.com.
Market periods like these have a way of making virtually everyone ask the question, am I okay? Meaning, is my portfolio and financial plan going to survive these latest seismic events? Especially when the news can swing from everything is terrible to everything is resolved almost by the hour. An important aspect of any financial plan is setting up the portfolio to provide income when wages or other sources of income stop or are not enough to cover our planned and perhaps emergency spending. A number of years ago, I sat through a presentation at an investment conference that caused more than a few light bulbs to turn on in my mind when it came to understanding what may matter the most to any investor when determining their asset allocation. It may also matter most to our financial peace of mind during times of market turmoil like the ones we're experiencing right now. So what's so important? Well, answering the question of how much money we need to allocate to stocks for long-term growth, and more urgently, how many dollars do we need to invest and save in bonds and cash for risk management and near-term lifestyle spending? The presenter put up a series of charts and graphs, but the most important was a worst cases in history table showing how long and how low different global stock markets had plummeted over the last 110 years and how long it took for them to fully recover. A full peak to trough to full recovery cycle in inflation-adjusted dollars. During market periods like the current tariff turmoil, I imagine that many investors are asking the same questions. Hey, how long could this last and how bad could it get? I think we ask the question because we want to be prepared so that our portfolios and plans survive the bad times and even the worst cases. Some of the historically worst cases for markets occurred during the World War II era. Japan saw their stock market decline by 97% from 1936 to 1947. It was 1969, or 22 years later, before the Japanese stock market broke even, reaching the same value adjusted for inflation as its previous peak in 1936. The French stock market declined over 87% between 1942 and 1950, only returning to inflation-adjusted break-even in the early 1980s. The worst case for the U.S. stock market was an 8-year period beginning in 1928, bottoming out in 1931 and then getting back to break-even in deflation-adjusted dollars due to the Great Depression by the end of 1936. For the global equity market, a capitalization-weighted basket of all countries' markets, the worst-case scenario also started in 1928, bottoming in 1931, but returned to break-even within 7 years. That's 1 year faster than the U.S. market alone. More recently, in the Great Financial Crisis, the U.S. market took 59 months to go from peaking on October 7, 2007 to trough on March 3, 2009 to full recovery by April 2, 2012. Looking at over a century of stock market history is just a good reminder about the importance of global diversification. Diversification spreads the risk and protects against any single asset or single country experiencing an almost unrecoverable disaster. I believed then, and I still do, that this historical perspective is crucial for investors evaluating their portfolio preparedness, no matter what the market environment we are in. A good goal for a stock market investor is never to be forced to sell while stocks are down or declining. The simple formula for successful stock market investing is still to buy low and to sell high. And if you can't hold stocks for the long term, and by that I mean 8 to 10 years or more, it's questionable whether you should be investing in them really at all. So while growth is very important for long-term success, meeting your lifestyle spending requirements today and tomorrow, including the rest of your life, is just as important, and a case could be made that it may be even more important. A good financial plan should tell you when you will need to withdraw money from the portfolio and how much will be needed year by year adjusted for inflation. This cash flow need for many of us begins at or near retirement because you now have financial obligations greater than all your other income sources like wages or Social Security combined. Based on these worst-case market scenarios that we examined earlier, any amounts needed above income for at least the next 7 years then should really be invested in some combination of cash and bonds. So here's a simple example of how to check and see if your portfolio is long-term tariff turmoil or any other potentially long-term market crisis protected. Let's say that you plan on starting to withdraw money from your portfolio for living expenses in 2026, about 8 months from today. And your financial plan shows you'll need $8,500 a month or so of income just to cover $100,000 of expenses per year. Now, $2,500 a month of that will come from Social Security, according to your plan, leaving $6,000 a month to come from the portfolio, again, about $72,000 a year. Now, if you don't want to sell any stocks while they're going down or before they have fully recovered, you look at that 7-year historical worst case and realize you're going to need just over $500,000 in cash and bonds by January of 2026. That's 7 years times $72,000. Now, ideally, you'd have started planning your portfolio allocation many years before retirement so that over the 7 years prior to needing the income from the portfolio, you would have been slowly building up to that $500,000 minimum. Of that $500,000, we'd advise you to consider holding 1 to 2 years worth of spending, say $150,000 in cash, things like money markets and savings, for example. And then the other $350,000 in a diversified bond portfolio with maturities varying from 3 to 7 years. As always, your specifics may look different from these general guidelines, but these should give a good starting point for your evaluation. Lots of people talk about portfolio allocation in percentages, but I think to really understand your investment strategy in terms of preparation for and protection from bad markets, it can be far more reassuring to think in terms of dollars. You and I don't spend percentages. We spend dollars and cents. And in this example, I'm showing 7 years of expenses isolated from stock market risk. Again, because 7 years is a historical worst case for a globally diversified stock portfolio. So now we've defined what I'd call your lifeboat, the cash and bonds to keep your income afloat for a potential long downturn in global stock markets. If you're more conservative and don't need to try and maximize your portfolio return to reach your goals, you may want to have more than your estimated 7-year cash needs in cash and bonds. Many people do. Okay, now we can zoom out and look at the bigger picture portfolio and plan. Let's say you have a $2 million total portfolio divided between a 401k, an IRA, an after-tax brokerage account, and a savings account. Your 7-year lifeboat again is just over $500,000. That represents about 25% of your total portfolio. If your financial plan says that you need the expected return of a 60% stock, 40% bond portfolio to reach your goals safely, well, you could choose to have another $300,000 of likely lower returning but less volatile bonds, which would stretch your cash flow lifeboat to over 10.5 years. If you like percentages, acceptable asset allocations for you would range between 75% stock and 25% bonds and cash to 60% stocks and 40% bonds and cash. This range of allocations is expected to cover the contingency of a 7-year or longer stock market dip, while at the same time providing enough stock market exposure to generate the longer-term return you need. 2 things here in closing. One is to recognize that in a period of big or sudden market declines, our fear emotion just kicks into high gear. Behavioral psychologists have found that our brains respond far more actively to what is happening right now than what we may know or believe to be true of longer-term market cycles. This is why many feel like they need to do something to respond to current markets. But for an investor with a solid long-term plan and a portfolio that has 7 to 10 years worth of cash flow requirements already built in with cash and bonds, most often the best thing to do is to hold your ground and live your plan. Of course, you may want to review your plan and portfolio with your advisor just to confirm that nothing has changed, and we would encourage you to do that. But oftentimes, the conversation and review of the facts is enough to calm our inner doubts and allows us to get back to living our lives as planned and with confidence. Second, if you don't have the amount of cash and bonds currently needed to cover 7 years of spending and you are at or near retirement, you have a couple options. One, of course, is to keep the portfolio as is until equity markets recover, and then have a plan already in place to work on funding that lifeboat allocation. If you are 2 to 3 years or more from retirement, you could also redirect all current and future savings to bonds and cash right now. You can do this in your 401k by having all future contributions directed to bonds, leaving your currently invested stock accounts as is. And if you're funding any after-tax accounts, again, direct all savings to cash and bonds, and don't forget to count any cash accounts that you already have towards the total you'll need. If you're in retirement and your cash and bonds don't cover 7 years of future spending, find out how many years they do cover. Again, the 7-year number represents the worst case for global equities in the last 120 years. Hopefully, this current turmoil will not result in a worst-case scenario, and there are plenty of reasons to think it won't. The economy and markets were all in good shape prior to the tariff announcements, and as long as this uncertainty and kind of tit-for-tat doesn't drag on too long, there's reason to think a recovery could happen fairly quickly. The best recent example of this is the COVID-19 U.S. market recovery in 2020. The entire peak to trough, when the S&P 500 was down more than 33%, back to full recovery, took only 4 months. By comparison, this current drawdown has seen U.S. stocks hit a low point of down just over 18% and is still less than 2 months old, fairly recent. Of course, the future of markets, like everything else, is unpredictable. Anything can happen, good or bad. But there is continued reason, we think, for longer-term optimism. If you haven't been giving much thought to how much bonds and cash you need in the portfolio in terms of spendable dollars, well, now's a great time to be doing that, while the motivation and this latest realization of what risk can feel like is front and center. Joe Wiggins, in his blog post of April 8th, 2025, he put it this way: "We might know that equities can fall a lot in the short term, but we won't truly understand what that means until we feel it. We are far more likely to insure our house against flood risk after it is flooded. Risk often only becomes real when we have experienced it." Everyone is feeling it, the flood or the sudden market decline right now. And while we would not encourage many portfolio actions, especially selling stocks in the midst of a downturn like this, it can be a great time to resolve to not be caught without a lifeboat when, not if, the next market turmoil arises. So, thank you for joining us today. If this has been helpful, consider sharing this with a friend, or if you're listening via podcast, give us a positive review. You can help us spread the message of educated optimism as an answer to anxious uncertainty.
The previous presentation by Foster Group was intended for general information purposes only. No portion of the presentation serves as the receipt of, or as a substitute for, personalized investment advice from Foster Group or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content, will be profitable, be suitable for your portfolio or individual situation, or prove successful. Foster Group is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Foster Group is engaged, or continues to be engaged, to provide investment advisory services. A copy of Foster Group's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fostergrp.com/disclosures.